Good afternoon and welcome to the FIREANGEL Safety Technology Group PLC final results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Zoe Fox, CFO, and John Connolly, Chairman. Good afternoon to you both.
Good afternoon. Thanks, Alessandro, and welcome to everyone. I will plunge straight in. Now, hopefully some of our guests on this webinar know something about the company, but in any case, I will remind everyone as to what we do. We've been around for about 20 years. We make alarms, we make smoke, heat, and CO detectors in the main, and we've sold approaching 80 million of those. Our model is that our main markets are primarily UK and Europe, particularly Northwestern Europe, and we sell to trade and retail. About 2/3 of our revenue comes from the UK. Manufacturing partners are in Poland and Asia, but we also have our own important CO sensor factory in Canada. We are in a good market with barriers to entry, and regulation frequently provides a tailwind that helps support our revenues, and I'll touch on that again shortly. Major customers are people like B&Q, Screwfix, and Amazon, but also we have a number of distributors and other partners across Europe. Developments recently concern the Internet of Things and connected alarms. In the old days of only standalone alarms, if a fire alarm, smoke alarm, or heat alarm went off in the garage, it might be some time before that woke you in your bed. The direction the market is traveling is towards more connected alarms, where if one alarm goes off, the others go off, and that fulfills our mission to protect and save lives through our technology. In terms of last year, the bedrock of what we're trying to do was our successful fundraise. We raised 9 million net of fees, and that was against a primary promise of improving our gross margins. Gross margins has been a big company weakness for several years. The improvement of that has been absolutely mandatory. And the fundraise has been the gate we had to go through to tackle that. So financial performance improved a lot over 2020, and in line with market expectations. We, as management, had a slightly mixed bag to it because due to supply chain issues, we missed out on a much better performance, both at the revenue level and actually at the gross margin level. Pleasingly though, demand has not been any kind of issue, and that demand continues into 2022. So as you see, the gross margin did improve, would have gone higher if we could have supplied all the alarms we needed, particularly in the last 3-4 months of the year. But another key highlight last year, and further detail of that came through in an RNS yesterday, is our agreement with Techem, who are a significant company in the digital and smart building space in Germany. We'll touch on that again shortly, but this is a very important item to talk about.
Good afternoon all. From finances, we are pleased with the performance of last year, off a year that was still very much disrupted by COVID, and particularly the knock-on effects on the supply chain which we encountered. It was a good performance. Revenue was up to £43.5 million. That's a 9% increase on the previous year. We had that gross margin improvement as well, where we are starting to deliver on a gross margin improvement plan that we started to put into place last year, and we're starting to see that coming into our numbers. So gross margin increased to 23.2%. That's a 3.4 percentage point increase on prior year. Making our underlying loss before tax of 3.4 million. That's over a 2 million improvement on 2020 numbers. From a balance sheet perspective, we strengthened it with the equity raise, which was 9 million, 9.8 million gross of fees and 9 million net, and also a refinancing of the government funded loans, the CL bills into a C bills, which introduced some additional cash into the business as well. So overall, a good performance of a tough year with increased revenue and those increases in gross margin.
So to go deeper on a few aspects, you've got the idea on supply chain. I think I'll major on what's different. If you read about it in the press last year, it affected us, whether it was sitting behind a ship stuck in the Suez Canal, ports in China being closed, ships into the UK not stopping at the port they were supposed to stop at, and so on. General inflation, and particularly, however, availability of components. So to give you an idea, in 4Q, we were forecasting needing about 600,000 of one particular output of one of the factories of our partners, and we could only procure 300,000 purely because of component availability. But that gives you the idea of the unfulfilled demand, a lot of which, by the way, persists into 2022. We have taken a number of mitigating actions, booked all our slots now, I think, for the rest of the year from China. And we did a significant root and branch review of channel and pricing. We absorbed a lot of inflation last year and into the very first part of this year. Our pricing is now starting to take effect. And because of the way we've reorganized our channels and our arrangements, if we needed to react to growing input costs again later in the year or next year, we can do it much more quickly and be more fleet of foot. However, the significant pricing impacts to our customers start to take effect now, and each month for the next few months will bite harder and harder. So we think it'd be quite exciting week by week to see the sales reports come in and the margin at which we're operating, because it will be very significant. Q1 product supply is much better than Q4, and Q22 looks to be about normal. On the quarter overall, even if we'd have liked more during the first quarter of 2021, we look to be about on target for our budget. So that appears to be moving behind us. One of the things we talked about at the time of the fundraise was to move to higher value activities, to get more output and margin and financial benefit for activities in the first world. The Techem agreement is significant. They're about an 800 million euro turnover company. They're eminent in their field. They operate in about 20 countries. I do point you towards the RNS because there is some complexity to this arrangement. However, it's so far been a very successful partnership. They are paying us to develop an alarm driven partly by German legislative movements, primarily for the German market. And so that development will be largely cost neutral for us. We do expect there to be spin-off IP and development benefits into the rest of our product range, funded by, in effect, by our partner. But we are on track to deliver this product to Techem in 2024, and hopefully with good volumes in 2025. We will receive a royalty on each product. So first off, all the development is funded by our partner, and secondly, we will earn a very beneficial revenue. In addition, there is a minimum royalty fee should, for whatever reason, Techem not manage to find the customers it expects, despite its bedrock forecast of some 7 million units. The minimum royalty fee after the development period is 3 million euros. So it is very beneficial, and we were very pleased that they selected our own CO sensor, because when we first signed with Techem, it was for 3 euros per product shipped from the manufacturing partner. And now, because our CO sensor will be incorporated, that will be over €5. So if this performs as per Techem's commitments, you can expectations, you can see the sort of maths. I think the potential market is bigger than that, but we all know that things go up as well as down when forecasting 3 years out. Always round, this sits somewhere between a very good agreement for this company and a transformational one. It is significant. We will report back from time to time. At the time of the fundraise, we talked as well about the fact that we burned too many first world costs creating alarms that might sell for £6, £9, £11 through retail, but maybe earn us 9 points of margin, 13 points of margin, 15 points. Therefore, a slice of our turnover dragging down the whole company. So we had already embarked on working with an already established partner in Asia to provide those low-end alarms themselves to us, which we could pass on at a higher margin. So those have started shipping. We shipped 30,000 to one major retailer about 3 weeks ago. In their first week, they sold 1,000. To another major retailer last week, I think we shipped 9,000 units, and we have about 180,000 on order of these low-end products. The effect of moving to these products, which give us a higher gross margin potential, will add about 2 points of gross margin to the overall business, and they have started to ship. So that's a crucial point. We're not going to do this. We are doing it, and it's happening now. Another aspect of driving the margin is around better quality sales, particularly connected products. We sold 33% more last year than in 2020, and these alarms sell very well particularly through online channels such as Amazon, and also well into the trade market. These are at significantly better margins for the company than through bricks and mortar retail or through traditional sales of standalone products. So this mix shift will drive the overall company margin shift. As I said, we didn't supply all the products we would have liked to in 4Q. Most of those that we failed to supply due to macro circumstances outside of our control, they were mainly connected products. So you can see there was a lot of margin improvement on offer, and that's those particular products just starting to ease off now and should be part of that improving journey. We note though that despite the challenge, particularly in retail, we did still manage to grow the company's sales overall. We're very pleased about that. Fire and rescue were very preoccupied with COVID duties, so they just weren't fitting the same number of alarms. But again, we signed a new agreement for 4 years with them, and we expect a bit of a mix shift there to make this also a driver of improving margins for the business. Again, the key is demand remains strong, but also the supply is expected to match demand in 2Q. So we're very satisfied with that.
So also during the year, we moved forward on the value chain improvements. So these were activities that we had identified in the business to improve our business processes and our efficiencies across the inventory and the value chain. So we transitioned our own products out of the plastic packaging and into cardboard. That's reduced our plastic waste by 10 tonnes a year, but also added 1% gross margin onto our profit. We've continued investing into our IT systems and business systems, which has improved efficiencies throughout. For example, we are continually increasing our number of customers that we process via EDI. So that means, a customer, for example, that used to send us probably 100 manual orders in a day, we were processing manually into our systems. That's now done all with electronic transfer files. So you can see the significant reduction in processing time, what that activity has given us as a business. So all of these value chain improvements are just helping the business work smarter, keeping the costs down as we're starting to grow the volume in the business as well.
And just a minor note, I mean, everyone watching and or listening to this webinar has listened to far more management teams than Zoe and I are ever going to meet, and you will be familiar with the concept of greenwash. The thing for us is we do already a lot in the E and the S and the G areas, but we haven't done it deliberately. So it's just a note that we intend to get more grown up about this, because actually it is underpinning of our brand and the positioning direction we will start to go on over the next few years. So actually it's a mandatory thing for us to get more serious about. And this is just a note that we will do so. And I think, as we all know, particularly the funds do want to see more responsibility from management teams. In a way, this is relatively straightforward for us, and in no kind of way a stretch.
This slide is in the back as an example of how we can see our gross margin improving over the next 2 years. So looking at the starting point of 2021, finishing gross margin around about 23%, and then those pillars of how we get from 21 margins up to, you know, just north of 30% by the time exiting out of 2023. You know, we are seeing inflationary costs across our product lines as we move it through 2022. You know, with that increase in costs is, you know, through the plastics, through the labour, through also our components, and we're seeing some large costs that are more deemed as sort of one-off costs where we're having to secure some supply on the open market this year. But we've been able to offset those increase in our product costs by those strategies that we've put in place that are being delivered now, and we can see that particularly as we're moving into Q2 in our numbers, and we've got new product launches. So you've got those value-added activities with the, you know, the lower entry products that are coming through. We've got the new COs that are coming through as well into the H2 of the year. So we do see our pricing strategies being able to offset those inflationary costs as we move through.
And we'll just touch back on gross margin in summary and outlook. Zoe.
So looking at the income statement for last year, as we've said, we see the revenue growing 9% on previous years, so up to the £43.5 million. We've got a gross profit increase of £2 million to 10.1. And, you know, those revenue and those margins increasing as we saw the restrictions of COVID-19 relaxing in our different territories during the year. And also 2 of our business units, UK Trade and International, had some benefits from legislation during the year. Gross profit growth, though, hindered by those inflationary costs on our product base. And certainly we started to see also the increase in our distribution costs and freight costs as we exited the year. So overall, that left us with a operating loss of 3.4, which is 2 million up on previous year, and a EBITDA of 100,000, so nearly back to that break even. But I think what's important is that for 2022 we will return to materially to a positive EBITDA. Moving on to the balance sheet, we strengthened the balance sheet in the year with the equity raise of £9 million, the refinancing of those government-backed loans introduced a further £1.7 million into the business. The working capital is probably the area to probably look at the most on the balance sheet and the movements of that. You know, our inventory was significantly lower as we exited the year, and we did have the creditors also offsetting on that. As our lead times on our components have moved out with our manufacturing partners, we are supporting their additional working capital exposure with our lowered creditor days. I would expect that to start to relax as we come out of 2022, and then we'll be able to tick those creditors days back up. And I think the other important area just to note on the balance sheet is that legacy battery provision. It's at 1.6 million for the end of 2021. We utilised just over £1 million of it during the year. We expect this now to unwind over the next 2 to 3 years predominantly. But the important thing is it is tracking to our forecasts as of today, and that's what we see as the foreseeable future on it. So on to the cash flow. I think I've probably covered off a lot of the specific line items around on the cash flow. So we've talked about the strengthening the balance sheet and the financing costs coming through into the business. The working capital movement is the biggest variance on prior year. Again, that's around the inventory and those creditor days. We spent £2 million on CapEx last year, 1.5 million on that on R&D. That's £1 million less than previous year, so that's benefiting from, you know, that tech development costs that are being fully charged back to the customer. At close of December, we had a net cash position of £100,000. We had no drawings on our IDF facility, and that facility is still at 7.5 million that's available to us, in addition to an invoice financing C-bills as well of £500,000. So from a cash flow point of view, you know, we ended up, as I said, on a small cash balance. And as we move into 2022, whilst we won't be cash generative on full year, we will get to be cash generative as we move into H2. And lastly, from the financial slides, a little bit more detail around that business unit revenue. We saw increases in UK trade and in international. As I've said, that was from a legislative drive in those areas, but also to remember that these two business units have our highest margins in the group. Performance wasn't quite as good in the fire and rescue service and utilities and leisure. Both of these business units struggled due to COVID-19 complications around restricted entry into properties, as well as the customers' priorities being elsewhere. UK retail also ticked back a little bit on previous year, whilst this business unit started the year really strong and certainly has the demand there for our products. Unfortunately, it was probably the worst hit from the supply chain challenges, particularly in Q4. And then on the slide, you can see European partner for about £1 million revenue for 2021. That is Techem. That has 3 different elements of the contract being recognised as revenue through there. So that does have the charging for the product development, the existing IP charge, as well as that €3 million guaranteed royalty that we will have. That is being treated as a contract and under IRS 15, and the revenue's been apportioned and recognised in line with our costs that the business incurs to deliver the product.
So on summary and outlook, I've done a few summary and outlook charts in my time. I think this is one of the more comprehensive ones. We have done what we said we would do at the fundraise, despite what the world has thrown at us. And we, despite everything, shipped 4.3 million products last year. Now, right now, we've got 1.3 million products on order to us, and we can start to fulfill that. But I think from the way the demand is going, even though the supply flow is normalizing, the demand just seems to keep on going, and it is the legislative drift in different countries at different times. We have enough components, we have enough visibility of components for the full year and enough understanding of labour and throughput to be confident in our full year revenue outlook. Where we feel bullish, however, is in gross margin, because I don't think if we wanted to, we can now stop the step change that we've worked on really for about 2 years to get to this point. I don't think we can stop the step change. It will happen pretty well on a weekly basis now across the next 3 or 4 months. We will soon see our first 30% GM month of the year, we believe, and exactly where we land will be on the exact mix of products and particularly the full supply of those connected products, which might come in at some of them in the 40s%, 50s%, even have one product that goes at 70%. So if we get the right mix of supply and the right mix of demand, then we'll definitely do very well this year. But it is really, it's a step change. And it doesn't apply to the whole year, but it's starting to apply week by week pretty well from now, based on the sorts of measures we chose to take, which are now coming through across a whole range of things. The Techem partnership, I think everyone must have the idea that we regard this as a big deal. Techem say it's their biggest project. And if I didn't say how Techem work, they deliver their services to real estate owners, operators, to landlords, and the landlords in turn sell those services to their customer base, their consumers in turn. But Techem service some 12 million properties, and what we are doing is going to give Techem an opportunity to help their own landlord type customers evolve their business models. That starts to be a really powerful argument, a really powerful proposition for Techem. So, you know, we are excited. I mean, Techem are excited, and we will from time to time report back. The next thing that is very much on our plate at the moment is in cooperation with Techem selecting the manufacturing partner, although we are the authority for that in the end, and we are down to a short list of 2. So that's significantly advanced, and the project overall, I think as of when I checked last night, is closer to 12% complete, because despite yesterday's RNS, the relationship with Techem has been close enough that we began this phase in December, this new phase, on a time and materials basis. And the performance of Techem as a partner has been very satisfactory in that process. We are in this improved financial position. We will have much better margins very shortly. And as Zoe said, we are going to be generating cash quite shortly, which will relieve a lot of minds who've looked in at us over the years. We are, of course, beneficiaries in our industry of the regulatory environment. The Techem agreement is in part driven by German regulation. There was also in November, Michael Gove's, I wish I'd written it on the chart, Department of Levelling Up, but it has a longer name than that, which eludes me. But in the social housing white paper of November, it posited mandatory CO alarms for rental properties in England and Wales. We've been in consultation with government departments, as have other industry players. We're not sure yet of the implementation commencement date or the compliance completion date, but we are in any case expecting the government to publish those dates fairly soon. I think if it's a very short date, which of course governments like, then all players in this industry will not have quite enough components. But if it's a sort of sensible and measured process, then it is clearly an positive upward pressure over hopefully a couple of years, and we are gearing up to meet it. Whether or not it becomes material on any given year, I don't know. I use it as an example of something that's out in the public domain, but which continues to help our business drive forward. And we just expect that kind of regulatory improvement in different countries as time goes by. There is always some enhancement to demand. And as we said, we expect to be materially EBITDA positive in 2022, and it will be a relief and a genuine pleasure to be around break even on the PBT front. So we feel really very positive. It has been a tough 5 years for the business, but we feel week by week it's not going to feel so tough pretty well from now, and we're genuinely looking forward to the next few months. Actually, it's exciting for us. Management teams use the word excitement. They don't know what it means half the time, but we do feel excited. So I think that's the end of our formal presentation. If IMC and Alessandro is happy, I would turn to questions.
John, Zoe, let me just come in there and thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab, which is just situated in the top right-hand corner of your screen. But just while John and Zoe take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. John, as you can see, we've received a number of questions throughout today's presentation, and thank you to all the investors for submitting their questions. Could I please ask you to read out the questions and give response where it's appropriate to do so, and then I'll pick up from you both at the end.
Yeah, thank you for that. Let me read the first one. I might get Zoe to answer it, but analysts are forecasting around 3 million for CapEx per annum. What is this being spent on?
So CapEx in our business, and certainly in the forecasts is, each year we spend probably between 1.5 and 2 million on R&D. So that is obviously enhancing our product portfolio. We have some line fillers that we need to develop over the imminent sort of 12 months. We've also got the CD mounted gateway that's launching this year. As we move out a bit further, then there will be a little bit more investment in that R&D as we start to develop our next generation of alarms. The other part of the CapEx is all predominantly really around tooling for our products as well. So that's obviously for the new products, but also replacement toolings, and then some investment obviously on IT. And with the selection of the CO sensor in our PACE sensors subsidiary in Canada, that'll need a little bit of investment as well to improve their production efficiencies.
Okay, and then there's a couple of questions I might kick off on and then hand over to Zoe. The first is analysts are forecasting net debt to rise to around £4 million by December 22. How will this be funded? What is the nature and size of your bank facilities, and how confident are you that a further fundraise will not be required? And then closely related, what can you do to avoid another fundraise? The business looks like it's struggling to generate any cash. Now, given that latter question came through, or both of them only 2 or 3 minutes into the presentation, frankly, guys, I feel we've answered this, but we're going to give a comprehensive answer even so. We don't plan a fundraise. We forecast more thoroughly than you can imagine in this business, and Zoe in particular spends a vast amount of her time making sure we're always pointing in the right direction. So we're confident we have enough cash to fund our plans and meet the market expectations, and I think you must see from what we've talked about exactly why we will be capable of generating cash in 2H. So I'm going to take that part as read. But Zoe, what would you like to add, for example, on the net debt and how we're funded?
And how we're funded. So, so our IDF facility is £7.5 million. We currently have just started drawing down on that facility, and we will forecast to a 2-foot drawdown on it during the year. In addition to that, there is another £500,000 that is available to us under the C-bills. So that, you know, certainly has our revenue increases, the availability on that facility and the way that can fund our working capital is matching how the growth in the business. And as John said, yeah, I've spent a lot of time doing the forecasts over the last few years, and you know, cash is very, you know, is important to any business, and I'm certainly been very, very closely monitoring that, and the forecasts go out and we can support the growth that we have in those analysts and market numbers. And
I'm just going to add the importance of one thing Zoe said. It's an invoice discounting facility. That's how we're normally funded. It's not revolving credit. So it can be drawn down if your working capital is needed to drive creation of stock in support of sales. So it's quite a positive measure, if you like, of future sales from our point of view, if you assume that we're sensible about managing stock. And stock, as you know, is quite low just now. Moving on, question again, what IP protection do you have for your products, and have there been any significant changes in the competitive landscape? Well, we hold about 86 patents, I think it is. We do keep an eye on this. We were doing some development work a few months ago. We did a search. We spotted that 1 time in 100 maybe that could in the future maybe be an infringement, and we just made alterations. So it's just something we work as part of the natural course of our business, but we do have a significant number of patents for those things that are special to us. Has there been any significant changes in the competitive landscape? I don't really think so, actually. And I think if competitors have started to really reassess their worlds and their lives in the last 1 to 2 years of what's gone on for all of us, then it's not apparent in the outside world. And I would say this, I think we're more creative and more visionary, and we are getting lighter footed. And because we had troubles, we learned how to manage this business. And I think we're well positioned as competitors, and we are definitely going in the right direction. So it's slightly long-winded answer, but no, we're not bothered about competitive activity to this point. Will we be a beneficiary of remediation work to do with cladding? Indirectly, it's the generic publicity this gives to safety and fire and smoke risk. One area where we are benefiting is, for example, we have a trial to do with data and a managed service going on with 5 blocks in a London borough at the moment. We've only just started. If everything goes well, we'll talk about it as the year goes on, but as an example of the sort of thing we try and do. The impetus for that is it was costing this borough £10,000 a week for a waking watch. That is the Victorian or Elizabethan idea, as in the first Elizabeth, where people would walk around looking for fire and calling out. And 10,000 a week, you know, 52 weeks of that, you're soon talking serious money on only 5 blocks. And some of the boroughs might have 80 blocks. So you can see the potential there. Can I give a sense of why Techem think the initial forecast is nearly 7 million units? They did this forecast. It was their part of their justification to well, justify such a major project and a partnership with us. Clearly, forecasts can, and it will go up or down between now and when the product starts to ship in late 24. But they did that based on named customers, so they know specifically those customers they believe, and one large one in particular who's made high-level commitments to them for the product. So it was diligently done, and we and they use that forecast. However, they have 12 million units through their customer base, 12 million residential units. A typical dwelling might have 4 alarms, 5 alarms, 6 alarms. So one can posit, I'm just doing maths, that the universe, the available universe to them might be 60, 70 million. Now, they would never, so I hope no one has sat there thinking, oh, that's really big. Well, yeah, the world's big, but we're not going to sell an alarm to everyone in the world. But it gives you the idea that 7 million is not a stupid number. It could come down from there, but clearly it could go up from there. And different customers and commercial arrangements come and go, and 2024 is still another couple of years out. And then the lives of these alarms will be 10 years, and the replacement cycles, it might take 5, 6, 7 years to sort of turn over all of the units they want to. So there is more potential. That doesn't mean it will happen. However, we have agreed between they and us that we will work with them on how best to market the product to the bulk of their other customers they've not yet talked to. And of course, later this year, we'll have much more comprehensive designs and renderings, and next year we should have mechanical samples and so forth. So there's the potential to work on these numbers and gradually, we hope, build them. Next question was, what is PBT consensus for 2022? Do you want to have a quick scrabble?
No, it is just below break even. I think is what we've already said. We would hope that we may be able to get that positive next year. Well, this year with a little bit of headwinds, but yeah, the consensus is just shy of that break even point.
Yeah, I mean, honestly, you can't imagine how thrilled we would be to go positive on PBT. I would be disappointed not to. I mean, really, more like despondent actually, but that doesn't mean it wouldn't happen. It's a long year. I'm not trying to guide you anywhere other than where the consensus is, but I'm trying to offer you how we feel about this. We feel if we can have a cash generative second half and get over the line on the PBT, well, we might go out for a modest glass of Prosecco as a management team at that point. Maybe not a modest one. Are there any large-scale connected home deployments in the pipeline similar to Ealing? At the time we signed Ealing, we had certainly 2 other quite well-developed big opportunities. Then COVID struck, and all that focus went, not just for us, but certainly for the many boroughs, social housing operators. And because of all that disruption and the worries of the industry around the government putting on them for costs to do with cladding and all of that stuff, and also the evolving legislative landscape and the additional responsibilities and issues coming out of the Grenfell process, that idea of £1 million, a £3 million PO has disappeared for the time being. I think it will come back, but that doesn't mean the opportunity has gone away. What we have found is people will continue to buy in the way they used to, which is to purchase alarms, hopefully from us, and they have been, and install them as part of their regular monthly maintenance cycle, rather than coming out with one big PO. So we miss out on the headline, but we don't miss out on the business. And so we do expect to sell more or less as many as if there were 5 more Ealings, but we'll see it in retrospect in the revenues and the GMs and the growth, we hope, less in the upfront purchase orders. is the TECM agreement exclusive? And can you, I feel I've updated, well, I haven't actually. Is the TECM agreement exclusive? They are the only people who will sell the product. We have the rights to the IP, and some of it will find its way into our core product set in due course. And we are the only people developing this product. But we weren't the only people they talked to. They talked to some, we believe, quite big names in our industry, and we were selected. Update on the Ealing contract. About this is a slight lack of precision from me. I hadn't thought about it for a while, but I think we've fulfilled about 60% of it. It has, due to access and so on, been slowed down due to interest in other products that are from us that are coming down the line. So it's taken a bit of a wavy thing, but it has gone forward. Where we haven't made a lot of progress, because really, if you're not able to supply at the speed you would like, then the conversation about the excitement, how you can use data to predict fire, is a bit later on down the line. But certainly it has progressed, and we're not quite 2/3 of the way through it. Will the Newell Brands divestment from BRK First Alert have any impact on the business, given BRK's stake in FIREANGEL? For those who don't know, we have a major shareholder, which is or was BRK, part of Newell Brands. They're in this industry. They are quite big in the US. Historically, they did a bit in Europe, and they were a business partner and so forth. The Newells have, or we believe, will complete a transaction on the 31st of March, unless I've missed any other developments, whereby Residio, New York Stock Exchange quoted, will complete the purchase of BRK. Residio is a spin out from Honeywell. So they will be a major shareholder, and we'll deal with them as we tried to do with BRK, which is treat them, have the sort of conversations in the investor rounds. They'd be welcome to have an introductory visit to our office sometime. Honestly, if the hidden question here is do we expect any kind of interesting conversations? Well, no. We're not in the foreseeable future. We didn't expect that with BRK, and it doesn't mean it will never happen. But we're just doing our thing, and Residio are going to be super busy with their significant acquisition there in the US. So they're just another shareholder, and actually I think it'd be fun, quite enjoyable to meet them. You don't every day get a new major shareholder, so I look forward to that. Is there an opportunity to license technology to other parties? Don't know. I rushed that question, but is there an opportunity to license your technology to other parties aside from TECM? The answer is probably not really, and maybe in due course with TECM's agreement, but that's just not a thing for us. It's just too far away. We've got to build this stuff first. How large could the sales mix of connected products be in the near term? I don't know how to answer that, but I'll give you one idea. I can't wait till 4Q, because it's a consumer thing and it's an online thing, but our connected products would have been fantastic in the lead up to Christmas with Black Friday and so on. And at the time of the fundraise, I was really genuinely, I couldn't wait to see the impact of 4Q in the consumer space of our connected products. And we started to get some traction with multi-packs, where people would spend £180 on a multi-pack, not £10 down at the local DIY store, but big money. And we were getting traction. And my Christmas was disrupted and disappointed by not having that excitement to look forward to. So I think, I don't know, but the trend of the world is to connected alarms. It is for everything, isn't it? I mean, why wouldn't you? Why do you want to have that alarm go off in your garage that you then can't hear, and then you only come awake when the flames are engulfing the side of your actual bedroom an hour later. I don't see why there won't be a continued drift towards a connected alarm just being the norm. But 4Q this year, I'm quite excited by, because I think, you know, given other things in the world being equal, I think we'll really see where the penetration can get to in that time. Is there a US opportunity working with Newell? Yeah, I think there is an opportunity. There's one or two companies, not with any substantive discussions, by the way, but who from time to time make an inquiry about whether they could use our IP and so on. Now, honestly, we are super busy. We have no bandwidth for slightly more exotic relationships in the US market. However, I think the possibility is there for the medium or long term, but we have no one particular in mind, and not at the moment Newell's, but it doesn't mean there isn't some potential for a tie-up on the technology partner front with, you know, Resideo. But I don't know, they're just one name to me amongst other home technology players in the US, and I think there are possibilities there, but you know, we won't be coming to the market to talk about it, I don't think, this year, next year, and possibly not even the following year. Our focus is deliver the gross margin, deliver a really profitable technology company here at FireAngel, and deliver Techem. And then we are in fantastic shape at that point, just fantastic shape. Now, I think we may have answered all the questions.
John, I think certainly, I think you've actually managed to address all those questions from investors. And of course, if any further questions come through, we'll give them to the company and we'll publish those responses on the Investor Meet Company platform afterwards. Just before redirecting investors to provide you with their feedback, which I know is particularly important to both of you, John, could I please ask you for a few closing comments?
Yes, the fundraise last year was the bedrock. We are really doing what we said we would do. And I'm going to say what I said before. I don't think we can stop that GM improvement over the next 3 months. It is not random and out of the blue. We're doing what we said we'd do and planned for, and it's starting to arrive. So, you know, it's one of those things. I can't wait for April and also second half. I mean, we will see the fruit of our labours. And believe me, when you're turning a business around, it's a long, dark tunnel. 80% of what you do, you don't see the light of day until way down the line. And then hopefully we're at that point, you start to see it again and again and again. So I feel that's where we are.
John, Zoe, thank you very much again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of FireAngel Safety Technology Group PLC, we'd like to thank you for attending today's presentation. That now concludes today's session, and good afternoon to you all.